here, who is a translator, so he will be able to help if we get anything come through in any of the Q&A as we go through the webinar. So hopefully between that, if you are a Spanish speaker, we can pick up on any of those points. So let me formally begin and welcome you to today's webinar. My name is Karen Sanderson, and I'm leading the IFR for NPO project on behalf of the Chartered Institute of Public Finance and Accountancy, CIPFA. And I'm joined today by my colleague Samantha Musoke, who is the project lead for Humentum. Together, CIPFA and Humentum are leading this project. So you're all very welcome. This is part of a series of outreach events for the project, looking at non-profit organisation consultation paper that we issued at the end of January this year. Today's webinar is about grant expenses and non-profit organisations that act on behalf of other entities. These are topics or issue papers 2 and 4 in part 2 of the consultation paper. And the objective of today's webinar is to familiarise you with the content of these issue papers and hopefully give you confidence to respond to the consultation paper. So the agenda for today will look at what we understand to be the issues facing non-profit organisations and the financial reporting challenges that this gives rise to. We'll also look at the different approaches outlined in the consultation paper for how we could take forward these issues. And then we'll finish on the consultation questions and how to respond to the consultation. We have some polls to get your inputs throughout the webinar, and we'll discuss the results of the polls and give you an opportunity to ask questions as well as we go through. Please feel free to add questions at any time using the chat function. We're expecting this webinar to run for about 2 hours, but that will be dependent on the number of questions that you have. We will allow some time for overrun, but if we haven't been able to answer all of your questions, we will follow up after today's session. So we're proposing 10 topics for inclusion in the first set of guidance. The 10 topics cover matters relating to the reporting entity, revenue and expenses, aspects of the balance sheet, and matters relating to the presentation content and scope of financial statements. We recognise that we'll not be able to cover all non-profit organisation specific issues in the first set of guidance, and so it's important that we include the ones that have the highest priority for the sector. The overview to part 2 of the consultation paper looks at all of the issues that have been identified so far and how we've prioritised them. And we're seeking feedback on the entire list of issues and their prioritisation as part of the consultation. In looking at each of the issues, we're focused on the project guidance objectives that go to the quality, credibility, transparency, and comparability of financial statements. The objectives are also focused on meeting the needs of users of financial statements, but in doing so, balancing the needs of preparers as well. So they kind of sit at the heart of what we're doing. Today, we're going to be looking at, as I said, grant expenses, which is issue paper 4 in the consultation paper, and NPOs, non-profit organisations that act on behalf of other entities, which is issue paper 2 in the consultation paper. Knowing when and how to recognise grant expenses has been a consistent issue that's been raised in our outreach discussions. And this can be more complicated when multiple parties are involved in distributing grants and act on behalf of other entities. We hear of multiple issues about what should be recognised and if grants are recognised, when that should take place. So rather than hearing me speak throughout this whole webinar, to introduce the topic, I'm going to share a video with you that reflects the experiences of a number of individuals from the non-profit community around the world. This video will provide perspectives on today's topics and describe experiences. So I'm going to set the video running, hopefully, and you'll hear me speaking to Sam about some of the things that she's been hearing about so far through the project. Hi, Sam. It's good to have a chat about your experiences of grant expenses, or should I say what you've heard about what other people's experiences are of grant expenses in the situations that they encounter. I'm keen to hear about some of those examples and to get a real sense of the experiences that people have in reality. So with the gathering that you've done, I wondered if I could ask you a few questions. So when we look at grant expenses in the context of the IFR for NPO guidance, what types of grant-making entities might this relate to?
So with the term grantors, I tend to think first of donors like bilateral or multilateral donors or private foundations. Now, some of them could, of course, be government agencies rather than non-profit organizations. But of course, there are also many international and local NPOs that give grants to other NPOs. And I think this topic is particularly relevant in that context. I think it's also worth mentioning that there's some of the language and terminology that's become common in this sector, where the primary grant recipient is called a prime, and then they'd give sub-grants to partners that are referred to as subs. I should say I'm personally not very happy with these terms because of some of the power dynamics embedded in there, but they are quite helpful shorthand in describing the various parties. So when I use those terms, that's what I'm meaning.
Have you got examples that illustrate the kinds of issues that a grantor might experience?
Sure. So one of the biggest that people keep mentioning is about when to recognise the grant expense. I can share an example close to home with the IFR for NPO project when we were just starting back in 2019. Our first 18-month grant, the donor gave us verbal assurance in May. Then we got the signed agreement that was sent through to us in August. The agreement said that we could charge the expenses incurred from June, and then the money came through in September. So thinking about their own June year-end accounts, I wonder if they recognized a liability at that time, even though the grant agreement hadn't been signed. I'd love to share also this clip from Stephen Ball in Canada. I asked him what challenges he experiences in recognizing grants to others.
After the partnership is developed, our next step will be to craft an agency agreement that clearly identifies the roles and responsibilities of each NPO, how funds will be accessed and utilized, what reporting will be required, and what will happen with excess funds. As a Canadian NPO who provides the funds to other implementing NPOs, we are required to demonstrate direction and control over our donors' funds and ensure they are being used for its intended use. The first issue I face relates to timing. I can record the expense at the time of committing the funds. I can record the expense at the time of transferring the funds to the implementing NPO, or I can record them at the time of implementing NPOs actually using the funds. To determine the appropriate timing, I will need to review our relationship and an agency agreement with each NPO. For example, I will need to take into consideration if unused funds must be returned at the end of the project. Both international and national standards will also help guide me in adopting the appropriate treatment. And then it's up to me to consistently apply the selected accounting methodology. A second issue I face in recording expenditures is ensuring the funds were used for its intended use. This is where the agency agreement helps. In addition to the agency agreement, receiving regular financial and programmatic reports will show how the funds are used. And finally, periodic site visits are a few ways to have confidence and demonstrate the funds were used properly. It takes all of us to work together in a true partnership to make this happen, right from the donor who has the financial resources to the funding NPO who is held accountable for direction and control of the funds, to the implementing NPO who has the local knowledge of the community to enable the greatest impact. Thank you so much for listening.
So Steve mentioned there how the treatment of the grant can depend on the specifics in the grant agreement. And I'd also like to share two contrasting cases from Latin America that bring that out quite nicely. So in one case, the prime drafted the sub-agreements in such a way that they would need to pay the grants even if their donor pulled out. So what they did is they recognized the liability immediately and they charged the full cost of the sub-grant as an expense to the donor, even before it had been remitted. And I asked, did the auditors have any problems with that? And she explained that they kept the funds on a dedicated bank account for sub-awardees, and it was accepted. So that was, quite an interesting one. And then in a contrasting case, also from Latin America, as a different prime, and now they structured their agreements with their subs so that any risk of the donor pulling out was passed on to the subs. They even went as far as only providing funding on a reimbursement basis. So in terms of their accounting, they recognized the grant expenses as it was remitted, as it was paid. But then what that meant is that they were charging the grant expense or recognizing the expense to the donor much later in the cycle. And that had an impact on their burn rate and their ability to access funds the following year. So some really, some interesting cases there.
We saw from last week's webinar on revenue that there's a distinction between conditions which need to be met before an NPO is entitled to a grant and restrictions which limit the use of the funds that are received. What happens if the grantor is imposing the conditions, looking at the other side? Have you got any examples of that?
Sure. So still in Latin America, there's an example of an INGO, or INPO, that gave a grant to another NPO, local NPO, to do research and write a paper about the procurement and supply chain of contraceptives in Chile. The grantee became entitled to each tranche of the grant as they delivered the various chapters of the draft report. And then the final tranche was only released on condition that the government of Chile actually accept the report. And I thought what was interesting about that was how there can be quite a fine line between a grant with performance conditions and a straightforward payment for services in that example. Then I'd also like to share a clip from Oumou Touré in Senegal. I asked her about they account for grants with conditions. She started by explaining some of the context in West Africa, gave an example of how the accounting is done there. And she also added a really valuable reminder that all this conversation here is about the general purpose financial statements, financial reports, rather than the donor grant reports. So let me share that with you.
In Senegal, and in many African countries which are members of the OADA, which is the Organization for Business Law Harmonization in Africa, we use an accounting and financial reporting standard, which is named CISCOADA, for more conversions towards the IFRS. So the question about how do we recognize grants when there are conditions, we have grant recipients which are allowed to give sub-grants to other organizations which are implementing partners. And same principle, the sub-grantor will only recognize as a grant expense only when the sub-grantee has made due justification on the use of the funds. And before that, it is recorded as receivables. Now, the issue is to emphasize that all these accounting entries will lead to general purpose financial statements, which are standardized and gives a global picture on the finance of the organization and also will enable comparability. But we should add the donors' specific requirements in terms of financial reporting, which are usually on a cash basis, like total funds received, total expenditures against budget categories, and available balance, and any other due statement as per the financing agreement.
So I thought it's also interesting to note that in this webinar and the presentation that will be coming up, part of the focus is on this technical aspect of when a grantor has an obligation and should recognize a liability, and then the associated grant expense. From chatting to people, I think that's easier to do when grant expenses is a single line item. But as Umu's video demonstrates, I think if
Sorry, is that video stopped for everybody?
you've got a prime and you're consolidating the reports from many subs for a project report back to the donor, it becomes hard to recognize any expense until you know what the sub actually spent it on, hence the use of advance accounts, which she mentioned there. And then the final thing I'd just love to share really is on this question of conditions. And I did hear a number of people say that it's not always very easy to tell if a requirement or a stipulation qualifies as a condition. And sometimes it can get a bit caught up in language and definitions. For example, in many grant arrangements, there's a requirement that you submit the last month's financial and narrative report, and that's a condition for receiving the next tranche of money. So that could be interpreted in different ways, and some people would say that's a condition and some people would say it isn't. So I know a lot of people are really hoping that the IFR for NPO guidance can bring some clarity to that.
Well, there's some big questions for us to look at there as part of the project, but I'm going to reserve judgment on that right now. But the other topic of this webinar, which is linked to grant expenses, is when NPOs act on behalf of other NPOs. And that could bring issues of whether an NGO is acting as an agent of someone else, doing their business for them, or whether it's acting on its own behalf. In the existing accounting standards, this results in binary accounting treatments. Either income and expenses are included as ours or they're not. But of course, in reality, the range of arrangements can, of course, be a spectrum. And I'd be interested to hear some examples that bring out these issues of responsibility and control.
Yeah, so one example comes from East Africa, where there's a large INGO received funding from a bilateral donor this was for a child protection research program. Basically to see if providing parenting training to the carers of at-risk children would have an impact on their social outcomes. So in this case, the INGO gave grants to 3 subs working on the project. The INGO had full responsibility for selecting the partners and the overall project management, the design, the implementation. They were certainly doing much more than just being a pass-through entity. And they weren't just sort of receiving money and then handing it on. They were acting very much as principals, and I think that would be a clear case of recognizing the associated income and expenses. And then switching the angle and looking at it from the point of view of the subs, were they acting as agents of this INGO or in their own right? Did they have their own income and expenditure, or were they just acting on behalf of the prime? And I think it really depended on whether you're looking at it from a project level or an entity level. So at project level, certainly the INGO really exercised full control and responsibility. There was also collaboration and partnership and cooperation to varying degrees, of course. The subs even had to report the expenditure using the internal coding system of the prime. So at project level, it does feel like it might meet that example of being an agent, but at entity level, they were entirely independent. It certainly wouldn't be fair to say that the local organizations, these subs, were puppets of the prime. So it just becomes fairly hard to define. Then I have another example that's even more grey. And here, a local country office of a bilateral funder gave a grant to a local NPO. And then that local NPO as the prime gave 2 sub-awards according to the program needs. And then under that agreement, the prime again had full control and responsibility for the whole grant. But then partway through, one of the subs had a fraud issue and the prime wanted to change and find another partner to work with. But then the donor intervened and said, actually, they didn't have the ability to make that choice. They had to use that original sub. So that brought up interesting issues. They had all the responsibility associated with that grant, but they didn't have the control to make the decisions, to take the decisions that they needed to. Yeah.
Yeah, wow. Clearly a lot of complexity in this, and your examples have illustrated there, I think, just how, I think, as you said, shades of grey some of these things can be that make it very difficult to actually make judgments. So Sam, thank you very much for that contribution and for those examples. It's been really interesting to hear them. Thanks again. So that's the end of the video. I think Sam wants to take the opportunity to thank a number of people who contributed to those examples.
Yes, thank you, Karen. So in addition to Stephen Ball, who's actually, I think, joined us today, and Touré, I also had a chance to get interview and have video recordings from Mustafa Kamal at Concern Worldwide in Ireland, and Milka Dinev, who's a Humantum associate based in Peru, who's worked with lots of different organizations. So I just wanted to appreciate and acknowledge their time and input, which is really helpful. Thank you.
Great. Thanks, Sam. And my thanks too to all those who provided examples or participated in the videos, which I think have highlighted the different facets to the issues that non-profit organizations face, because these are real examples of the issues that are outlined in section 1 of issue paper 4 on grant expenses and in section 1 of issue paper 2 on NPOs acting on behalf of other entities. So we think that there is the range of transactions and considerations that relate to those create a number of issues for non-profit organizations. And at this early stage in the webinar, we're interested to know whether these issues resonate with you. They're clearly not exhaustive, but it's good to make sure that we've kind of got a similar a starting place in kind of thinking about the issues that non-profit organizations face. So we want to do a brief poll to get your input. There's 5 questions that we would like to put to you. Question 1 is about your experience of when to recognize a grant. Question 2 is about your experience of knowing how much to recognize. Question 3 is about your experience of knowing who is agent and principal in a transaction. Question 4 is about factors that impact the ability to understand agents and principals. And question 5 is about transparency. So Paul, could you please launch those polls? When it appears on your screen, you'll see that you'll need to scroll down to get to all of the poll questions. So I'm going to give you just a bit of time just to read through the questions and think about how your thoughts on each one. So how are we doing? Can't see. Ah, great to see the first response come in. give you a little bit more time to put in your responses. Okay, just a few more seconds and then I'll ask Paul to close the poll. Okay, Paul, can you close the poll for me, please? Great, thank you. Right, so what did you have to say about this? Well, in terms of it being difficult to determine when to record a grant expense, not quite 50-50, but certainly a balance of views around, with more people saying that it's a problem than not. So between it being a real problem and sometimes a problem, 59% of you here on the webinar today are saying that that can be an issue for you. But interestingly, 41% are saying that it's not. In terms of how much to record, similar kind of split. Actually, 55% saying it's not a problem, but 45% saying that it can be somewhat difficult to do that. But I don't think anyone is saying that it's a really, really difficult issue. In terms of agent and principal, again, 55% are saying that they don't think it's a problem, but 45% of you are saying it's either a real problem or it can be a problem sometimes in terms of what you experience. In terms of the types of issues that you're experiencing, a pretty even spread across the factors that we identified. The most predominant one being part of a consortium is the lead reason, but reasonably closely followed by using subcontractors to distribute funds and separating administration of grants from decision making, where 36% both find that an issue. And then lack of formal agreements following that. So I think interesting to see the balance of issues that you encounter, and that actually it is across all of them rather than any particular one that stands out. And then final question about transparency. So half of you think they are transparent but hard to find. I should share with you that we ran a webinar earlier on today and that result was pretty similar in terms of what they said. But you as a group are also saying that actually for a lot of cases they are relatively easy to find. Okay, so that's kind of a bit of a sort of stock take for us, a bit of a share point. And I'd just like to now kind of open up and just pause to take any questions that you might have on what you've heard so far. Is there anything that you saw in the videos that you want to ask about, or is there anything in the poll responses that surprised you that you want to comment on as well? So if you have got any thoughts, please feel free to put those in the chat that's there. Sam, I don't know whether you've had a chance to look and if there's anything there at the moment that you would want to highlight.
Yes, absolutely. So both Ayomide and Prosper had great points in the chat. If you'd be willing to unmute and just share those questions and observations, that would be super. Prosper and Ayomide.
Thanks, Samantha. This is Ayomide. So my question was around the principal agency consideration, and I was saying that if we apply that to the prime and sub relationship, doesn't that then escalate above to the donor and prime relationship as well?
all of these things are kind of part of a cascade, really, and I think it depends on how many people are involved in them. But I think we do have to look at each of the parties. And last week we were looking at the revenue side of receiving grants, and clearly that's part of the chain that happens. So I think we do have to look at all parties and the impact of those transactions on their financial statements. Hope that answers your question.
Maybe can I add something else there, Karen? I think what is interesting is that there is a sort of power dynamic sometimes, and sometimes the primes want to recognize all the expenditures of their subs in their own books of account, and that makes them look bigger. And I've been hearing from different stakeholders that some organizations will say, well, we'll only recognize the part that is our income for administering the grant. We won't double count the part that we're passing on. Yeah. So I think it does have an impact in that prime, so that the donor prime relationship needs to be sort of looked at through a lens of agency and principle to know how to do the accounting. I think that, yes, I think you've made a great point there.
Great, thank you.
Prosper, do you want to come in with your question?
Okay, yeah, sure. My question is pertaining with revenue recognition, especially when we have what I would like to call donor requirements, which are in the donor contract, and we have our own policies and procedures, and ultimately we also have the government. So it may come to, it may be that the organization itself has got the policy of recognizing income or revenue as and when they expense, right? However, the government is coming in and saying, can you please tell us, give us a report which actually highlights all the income that you're expecting. So I'm looking at a situation whereby I have a grant with a major donor, which is of 5 million, and the government is expecting me to recognize that in this current financial year, meaning to say that in the future, I'll make in this current year, it will seem like we have a profit, and in the future, we will have a loss. Mm-hmm. Then at the same time, we are saying the organization with its own policies and procedures, the board is expecting to see something which is different, whereby they are saying, can you be in a position to say the money we have actually received, this is independent of what you have agreed with your donor, can you be in a position to provide a report on that, which is another procedure which one would need to do. Then the main donor would say, okay, we have an agreement with you, but we're not putting any guarantees that in the future, if anything happens which we have no control over, we will be giving you these funds. Meaning to say that in this first year, if you report on all the upcoming revenues that you may have, in the following years, what will you do about that? I hope I'm clear on that.
You outline an interesting situation there, Prosper, and one that we've heard a few times through our outreach. I don't want to get too much into revenue in this particular webinar, but very happy to kind of speak to you outside of it. But you're absolutely right in terms of kind of, these are things that we are thinking about in terms of the overall project. This project is about general purpose financial reporting, and we know that there are lots of different stakeholders out there who have got their own requirements. What we're trying to do through this project is try and meet as many of those requirements through a single set of guidance, but that may not work in every situation, and that's kind of why it's important for us to kind of gather information about the types of circumstance that people have, so that we can be trying to work through some of those things and try and harmonize as much as we can, so that there aren't multiple different sets of statements that people are having to produce. Sam, did you want to add something to that?
Yeah, just briefly to say that you've talked there, Prosper, about the revenue recognition side and how we might have the agreement, but we can't be sure we're going to get it. So that kind of, I think you used that phrase. And I think the counter works from the grantor. Maybe we've got agreement, but are we obligated to give it. And I think the similar considerations impact revenue recognition and also expense recognition about this obligation to pay. So I think you've hit on something really central to the kind of conversation today as well.
Yeah, great. Sam, if there's nothing else, I'll move on. Is that okay?
Yes, sure.
Yeah. Okay. So I'm going to move on just to talk about the financial reporting challenges. We're looking at the financial reporting challenges, as I said, of grant expenses, but also where NPOs act on behalf of other entities and distribute cash and other resources on their behalf. In some of these arrangements, the non-profit organisation may be acting as principal and effectively giving the grants in their own name. And in others, they may purely be the conduit for the decisions that somebody else has made about the allocation of resources. So in looking at these financial reporting challenges, we're going to be highlighting challenges around recognition and disclosure as the most significant issues for these particular topics. Grant expenses are not currently explicitly covered in international accounting standards. And with no specific guidance on grant expense transactions to assist non-profit organisations with recognition, the accounting treatment of grant expenses can be a significant issue. So in terms of recognition, we're concerned with issues like when should a grant be recognised within the financial statements? And we're also concerned with what should be recognised when, particularly if the grant is issued with some kind of limitation or stipulation attached to it. In terms of disclosure, we're interested in whether there's any information that should be disclosed in the financial statements that will make it easier for the readers to understand what is happening. And it's these aspects that lie at the heart of the challenges that are discussed in the consultation paper. So the first issue to consider is about the identification of commitments. What promises have been made and how are these communicated? Difficulties can arise because it's not always clear what has been promised by a grantor to a grant recipient, over what period of time, and whether there is an arrangement that binds the grantor, a bit like Prosper was just talking about there. So if there is a grant agreement, this will help set out the intentions between the two parties. But if a grant agreement doesn't exist, then the intention may be less clear and potentially make the situation more complex. This is particularly the case if grants are awarded over multiple financial reporting periods. In this situation, the grantor will need to consider whether the whole amount should be recognised as an expense immediately or not, recognised until the reporting period intended in the multi-year arrangement. A judgment will be needed if the arrangements between the parties are not clearly set out. Payments of grants may be made in arrears, in advance or in arrears. So the cash expense could be an upfront payment of the whole grant or released in stages through the agreement. If no money has yet been paid by the grantor, the question is whether the commitment needs to be recorded, and if so, how much. The timing of payments, either in advance or in arrears, will be a factor in informing the judgment about when to recognise the expense, but it might not be the only factor. These factors and considerations together will impact the timing of the recognition of grant expenses. I should add that there might also be measurement issues if the grant covers multiple reporting period and the time value of money is significant. So when making a grant, grantors may impose conditions on the grant recipient, as we've heard. These conditions will impact when a grant is recognised by the grantor, because the grantor might only be obligated to the expense when an activity has been carried out. It might not be appropriate for the grantor to record an expense if the grant recipient has not carried out the activities expected of it by the grantor. Where there are conditions in a grant arrangement, these might be specific or they might be general. For example, in giving a grant, the grantor may simply require that the NPO uses the grant to, say, plant trees in a defined geographic area over the next 12 months. This condition is quite generic in nature with no defined milestones or volume thresholds. Alternatively, the grantor may require that a defined number of trees are planted in a given time frame in specified locations, with the grant linked to the number of trees planted by specific milestones. With this more specific set of conditions, the grantor might not have a commitment or an obligation to the grant recipient until it knows that the trees have been planted. For some conditions might be more significant than others, which can also impact assessments or judgments as to whether conditions have been met. If a grant recipient has met the central conditions in an arrangement that go to the core of what's there, the question arises as to whether that is sufficient to confirm to the grantor that the entire amount is due. If conditions are to be met in stages, the grantor might need to assess compliance at each of those. And that might give rise to practical issues about estimating the amount of grant to be expensed. So significant judgments may be required to determine when a grant expense should be recognised and how much. As with commitments, where the arrangement between the grantor and the grant recipient are documented in a grant agreement, knowing what to recognise may be clear. But where no grant agreement exists, this could be challenging. There are separate issues where the conditions relate to items that are acquired by the grant recipient for use in the programme. For example, it could be a vehicle. What happens if these continue to be used after the programme has finished, or if items are sold by the grant recipient? Is the grant recipient free to do this, or is there any requirement to return assets or proceeds to the grantor? We don't believe that this type of return requirement is normally the case, and that grant agreement includes sort of return conditions or stipulations, but we're not sure whether that assumption is correct, and you may be able to help us with this. Because we believe in practice there may be legal barriers to the return of grants or contributions. However, if a grant agreement does include return conditions, the grantor will need to consider the implications of this and whether or not they have an asset. Because the grantor might in effect have an asset in the period prior to the grant recipient satisfying its obligations under the grant agreement, and it might need to recognise this. So a separate transaction may need to be recognised for this kind of arrangement. So I've talked about conditions, and it's these conditions that give rise to an obligating event between the parties in an arrangement. It is the triggering of an obligating event that is needed so that the grantor can recognise a grant expense. There can be a challenge in identifying the obligating event. This challenge exists whether the relationship from the grantor to the grant recipient is direct, in other words, one NPO making a grant directly to another NPO or entity, or indirect, with one non-profit organisation passing on a grant to an intermediate non-profit organisation before it reaches the intended recipient. Sam described this earlier as a non-profit organisation providing resources as a prime, and then the prime providing resources to a sub. Indirect relationships can make situations much more complicated, particularly if non-profit organisations are working as part of a consortium. And we saw that as a key factor raised in the first poll that we did. So if a non-profit organisation is an intermediate in an direct relationships, in other words, it's acting on behalf of another entity, it will need to consider whether it is acting as an agent in the transaction or whether it's acting as a principal. And I'll come back to that in a minute. In a direct relationship, and even more so in an indirect relationship, it might be difficult for the grantor to know that relevant conditions have been met and therefore that there is an obligating event. Having monitoring systems that provide information about what is happening and whether there has been an obligating is needed. And we heard that in the video that Stephen Ball provided for us, where there were steps that were needed to take to be able to determine that. So determining whether an obligating event has occurred has practical implications, which could be difficult to implement and could be costly. Each grantor will need to consider each promise made to grant recipients separately. And this could be onerous if a grantor has made many grants. A portfolio approach to these grants might be possible in some instances. For example, it could be possible if a grantor has made a large number of small grants for similar kinds of activity and has a track record from past experience, but it will depend on the circumstances. Grantors may need to recognise an accrual or a provision in their accounts if they haven't made a transfer or cash payment before an obligating event takes place. So where the grant recipient has met the grant conditions, or when the grant has no conditions, the grantor will need to accrue these amounts and recognise an expense. It's also possible the value of grant promised by a grantor cannot be measured. This could be because because they're stage payments and the latest stage is not measurable for some reason. If it can't be measured and the probability of its value can't be determined so it can be quantified, then these would be disclosed in the notes to the financial statements as contingent liabilities. So there is an obligation still to provide information. On the previous slide, the slide we've just finished, we mentioned that where a grant is passed from one non-profit organisation to an intermediate non-profit organisation and then onto another, the intermediary needs to decide whether it is an agent or principal in that relationship. Intermediaries need to understand whether they have the rights to control cash or other assets that have been passed to it by the grantor, and whether it has the economic benefits or the inherent service potential that come with those assets. The right to control the asset will come from whether the intermediary has been given the ability to make decisions about the allocation of the resources that it has been given. So, for example, an intermediary may receive cash from a grantor to purchase laboratory testing kits. As part of the arrangement, the grantor may say that the monies need to be spent on testing kits, but the intermediary can determine what sort of testing kits are purchased and who should get them. In this scenario, the intermediary may have rights to control the cash because of the scope of the decisions that it's able to make about who ultimately benefits from this. However, this might not be straightforward, particularly if the grantor then intervenes in a decision made by the intermediary, as we heard in Sam's example earlier. Where the intermediary controls the cash or assets, they should recognise them within their financial statements. This means that they would record the cash or asset inflow and outflow and revenue and expenses. Any cash or assets held at the balance sheet date would be shown in the statement of financial position. If an intermediary is simply passing through cash or other resources to another organisation in an administrative capacity and does not have the decision-making ability about the allocation of resources, then the intermediary is acting as agent. And this is the case even if the grantor pays the intermediary to make the transfers. Such a payment would be a fee for an administrative service being provided by the intermediary and recorded as their transaction for that purpose. But the cash or other resources being passed through the intermediary would not be recorded in the financial statements. And this can get quite complicated where the intermediary may be a grant recipient as well as administering grants on behalf of the grantor. So if an intermediary is acting as an agent, then the funds or assets that it has are not recognised by the intermediary in its financial statements. There would be no revenue or expenses or associated cash or asset inflows and outflows, other than any fee for acting as an intermediary, or as previously mentioned, if the intermediary itself is entitled to any kind of payment or grant. Any resources to be passed on could be held in some form of holding account outside of the intermediary's own account. It's also worth noting there could be a creditor or debtor position for payments to be made to the end recipient if cash or other assets are owed or owing that should be transparent in some way. So there are big presentational differences depending on whether the intermediary is holding assets on behalf of another entity or whether it is holding it as an agent or just dealing with it as an agent. And this raises questions about how these types of transactions should be presented in the financial statements. So taking account of all the points that I've made so far, for a non-profit organisation that awards grants as a grantor, grants could comprise grants paid, and this could be grants made in advance where there are conditions or performance obligations placed on the grant recipients. They could be grants paid in advance where there are no specific conditions or performance obligations placed on the grant recipient. They could be grants paid in arrears where there are specific conditions which have to be met, or they could be grants paid in arrears where there are no conditions. They could be contingent liabilities where it is not possible to quantify the amount due to a grant recipient under an arrangement, but the grantor does have a commitment. They could be commitments where there is a promise to pay a future grant, possibly in future years or years, but the promise is not sufficient to have created a liability at the balance sheet date. And in addition, there are grants that might pass through a non-profit organisation as they're acting as an agent on behalf of another entity. And these are not grant expenses of the non-profit organisation itself. You can see that this could create a complex picture of a non-profit organisation's grant expenses, both for the current financial year and for future years. And with this potential for complexity, it's important that non-profit organisations can be transparent about the nature of the grant expenses that it has incurred, its promises for the future, and the grants for which it has some kind of fiduciary capacity because it's administering them on behalf of another entity. There is another aspect to transparency, and that is related to how grant expenses are shown in the financial statements. Grant expenses should not be netted off from the contributions received, and that's irrespective of where they're presented. A gross presentation should be maintained in income and expenditure and within assets and liabilities. Funds granted or donated should also be presented gross. And this question might arise particularly where an intermediary is a principal in a relationship that both receives and pays grants. So with these complexities, disclosure of the amounts passing through a non-profit organisation or assets in its custody might be useful. And this is because donors and grant providers are likely to be interested in the security and fiduciary responsibilities that an intermediary has for funds passing through it, or the assets that it's holding in custody. The intermediary is accountable for the assets in its care, and disclosure provides a mechanism for this accountability. How such resources from agency arrangements could be reported in an intermediary's financial statements is important. A gross disclosure reporting approach, similar to when an intermediary is acting as a principal, could provide additional transparency, but this isn't part of any existing international standards by way of approach. But irrespective of the approach taken to disclosures, describing agency and consortium arrangements is important to understanding key relationships that a non-profit organisation might hold and its role in those relationships. And in particular, donors and other funders may wish to fully understand the financial performance and risks that a non-profit organisation faces as a result of these arrangements, and particularly where they're part of a consortium. There are also questions about disclosures by way of programme reporting. It's arguable that financial reporting should cover where an intermediary is both agent and principal, where this would provide full details of a program that it's involved in. And this is because the agency element of an intermediary's activity may have an important bearing on the program it's delivering. And it provides an opportunity for clarity and transparency. And there's also that opportunity to set out the impact of those programs on individuals and communities. Disclosures about commitments not yet reflected in the accounts are also important, particularly for non-profit organisations that award significant grants. Commitments can set out future obligations that might have a bearing on the future operations and activities of a non-profit organisation. Consideration also needs to be given to the presentation of grants in the statement of financial performance. An organisation will need to consider whether an analysis of expenses by nature or function provides the best information to stakeholders. We're not going to dwell on that today, and there will be a webinar coming up at the beginning of September that will talk a bit more about that topic. So do these sound like the kind of financial reporting issues that you are experiencing? Do you recognize some of the things that I talked about? We'd like to get some feedback, and we're going to ask you 3 questions as part of that. Question 1 is about your experience of these issues. Question 2 is about the challenges that concern you the most. And question 3 is about where you think our focus should be as a project. So we'll put those questions up on the screen for you now. As before, you'll need to scroll down to come to all of those questions. And I'll give you a couple of minutes to read through the questions and to consider your responses. Okay, we have our first, we have a couple of responses through, that's great. Let's give you a bit more time. I'm going to give you another sort of 20 seconds to finalize your response. Okay. Paul, if you could close the poll now, that would be great. So, do you experience these challenges? Well, I think all of you who've participated in the poll have said that this is something that is part of your life, at least sometimes, if not more often than that. And 64% of you have said that this is something that you sometimes experience. So it's kind of reassuring that we kind of have this topic on our program as something that you encounter. In terms of the challenges that most concern you, let's have a look at those. So just under half of you saying that knowing when there is a constructive obligation is a challenge that you encounter. Just checking what else is there, but there's a lot of, I think there's a lot of support, if that's the right word, for some of the other challenges that we've potentially put out there. Knowing when to recognise a grant that has conditions, had 36% of you responding, and knowing how much to recognise where there are conditions, has 32%, 32% also not having an agreement to fall back on, and another 32% being accountable for grants but not being responsible. So I think there is kind of a high, as I say, a high level of support for the kinds of challenges that we've identified. So again, it's encouraging that we've got the right kind of issues there. And in terms of where our focus should be, so the lead response to that was having guidance that sets out which expenses should be included in the financial statements, and taking that as a link to when we have a constructive obligation. That was response to the earlier question. A lot of support, 48%, wanting practical guidance on how to deal with indirect relationships, and 44% having guidance on when to recognise grants with conditions. So I think those were the highest scoring items, but again, a lot of you recognising some of the opportunities here, and things that we perhaps can focus on as a project team in terms of how we take forward this topic. So I'll stop sharing those results, and as before, give you an opportunity to ask any questions that you might have in terms of what you heard in that segment, and whether there's anything in the poll that stood out for you in terms of any surprises, things that you thought wouldn't be there or would be there. So again, I'd like to open it up for any responses. Sam, is there anything that's coming through the chat that we should pick up on?
So there's let me just spotlight here. So there's been some comments. I don't know. I'll leave it up to the individuals if they want to unmute and mention. But David Hardridge, must be late at night for you in Australia. Akintoye and Syed were talking about types of grants, and somebody who's only called iPhone also had some comments. So if any of you would like, or anybody else would like to unmute or put your hand up and share your comments, that would be great. And also, if you would like to put a question in Spanish, maybe Fernando, you could quickly unmute and just say in Spanish that anybody who'd like to say a question in Spanish, please type it in and Fernando can share it with us. So if anybody would like to.
So let's get to David. So David, you have your hand up. So.
Yeah, look, the accounting policy we use distinguishes between grants and procurement in terms of recognising an expense. So if it's for yourself and your own activities, as such, like electricity and insurance, we do the accruals bit.
Yeah.
If it's a grant, and I'm probably jumping ahead a little bit to the different models, and in particular the one I'm looking at the moment is the International Public Sector Accounting Standards Board. Mm-hmm. and they look at sort of, I call it mirror accounting. So yeah, when people are talking about when to recognise revenue or defer revenue, there's the immediate response, well, shouldn't we sort of mirror that and have the same accounting from the spender, the grantor? And so if you've got essentially grants paid in advance, it's, well, the cash is gone. What asset do you have if the amount is in the recipient, I think it's called the sub in this webinar, hasn't been spent? Do you really have an asset? So there's a flip side to, if the cash is gone and you're not recognising expense, so you're recognising an asset. On the flip side, if payments are made in arrears, and there was comments about construction and things that are paid after the event, And with the accounting we talked about last week, possibly you'd recognise revenue for the activities that you've done. Does that mean that there's an expense on the other side? And you've talked about that with obligations and things like that. But trying to work that out, anything more than one grant basically is just horrendous, I would say. So all the things that you've said are quite valid, but in the end, we come back to essentially just wait for the bill or wait for the report to come in, which could be any time. It could be linked to financial years, but then people have different financial years. It could be during the particular financial year after 6 months. Sometimes these things come in. And also with the government, you talked about, you didn't think there were many cases about returning money. Essentially, all our government grants have what we call termination for convenience clauses. And those clauses are that the grantor can say, no, I want to stop things. And it's for whatever reason, you can just stop it. And you return the amount you haven't spent. No, we're not going to chase after you for what you spent in accordance with the agreement, but anything unspent we can get back. So that can cause some issues as well.
Yeah, I mean, you've covered a range of things there, and you know, you're right. The work that IPSASB is doing, looking at grant expenses and kind of a mirror kind of arrangement, they're still working through that. And still looking at the comments that were raised in response to the consultation that they recently carried out. But it's clear it's not straightforward, and a lot of it relies on perfect information between both parties, and the reality of that is quite difficult to achieve. And I think has been mentioned to us a few times is kind of the value of simplicity, and feeding that in as well. So I think there are a number of things for us to think about in working those through, and we are keeping a very watchful eye on the work that IPSASB are doing, and how whether that is useful to the work that we're doing on non-profit organisations. So thank you for that.
Great, thank you, David. Then I wonder if, Fernando, would you like to come in and share Jose's question? I can't understand it, but if you could come and share that with us, that would be super. Fernando, are you there?
We lost Fernando.
I see his, maybe we'll have to come back to that. Fernando, are you able to share Jose's question for us in English? Okay, maybe we'll come back to that.
Yeah, can I suggest we'll have an opportunity for questions a bit later. So
sorry, Sam. Yes, I was here translating into the chat into English the chat. Give me 5 seconds, please. I can also translate it immediately if you want to do that. But I was almost done with the second question on the chat.
Do you want to come back to us, Fernando, at a later point? Yes. Okay, that would be great. And we'll, if there's nothing else, I'll continue at this point. As I say, there'll be other opportunities to ask questions a bit later if we need to do that. Before we move on to the alternatives, which is the next section of this webinar, I just wanted to briefly talk you through the hybrid model for the development of the guidance that's set out in part 1 of the consultation paper. This model proposes the use of existing international frameworks with support from national frameworks. And in this model, IFRS for SMEs is proposed to be the foundational international framework. And this is because IFRS for SMEs is a single standalone set of guidance that is periodically rather than continuously updated, and so could provide a stable base for the guidance. It's also intended for many different sectors as well, and so it has a broader base. But as we know, IFRS for SMEs, with its focus on private sector transactions, doesn't address all NPO specific issues. So we're proposing that the full IFRS suite of standards and the full IPSAS suite of standards and their conceptual frameworks would also be used where IFRS for SMEs doesn't address an issue that's specific to non-profit organisations. We're also proposing that the model draws on jurisdictional level guidance to help develop this NPO specific reporting solutions that would also include disclosures. A number of countries have NPO specific guidance that have well thought through approaches to transactions that are specific to non-profit organisations. But depending on the country context, this can lead to differing solution, meaning that there is no single national based solution. It differs depending on which country you're in. So adopting this combined approach will mean that we can access the most appropriate elements of existing guidance without starting completely from scratch. And the alternatives that we're about to discuss kind of utilize this model to varying degrees, but are not a slave to it, because obviously at this point we're consulting on this model as part of the overall consultation. And if you have any thoughts on this, there's still an opportunity for you to contribute as the consultation on part 1 closes this Friday, the 30th of July. So there's still time to put something in if you've got a view on this model that exists. So currently, international guidance doesn't explicitly deal with grant expenses. Current guidance rests under the provisions for the recognition of provisions and reporting of contingent liabilities within IFRS, IFRS for SMEs, and IPSAS. The relevant standards are IAS 37, provisions, contingent liabilities, and contingent assets. Section 21 of the IFRS for SMEs standard on provisions and contingencies, and IPSAS 19 on provisions, contingent liabilities, and assets. Under these standards, a grant expense and a liability is recognised when an NPO has a present obligation to fund another entity created by a past event, and the amount of the grant can be reliably measured. The past event could be a legal or constructive obligation, but it is something that effectively binds an organisation. So recognition of the grant would take place when an NPO has no realistic alternative other than to settle an obligation to pay the grant, and therefore it's probable that there'll be an outflow of resources. So when an expense is recognised, it follows the relevant standards requirements for presentation, measurement, and disclosure of the expense, and cross-reference needs to be made to the nature and function of expenses. Analysis that I mentioned earlier is subject to a separate webinar. The timing of the recognition of a grant would depend on any conditions included in the grant. That is when the conditions are such that there would be no realistic alternative to settling the obligation to pay the grant. So if there are no conditions and an obligation has been created, then the grant would need to be recognised as an expense in the reporting period when the obligation was created. And the standards also provide for the time value of money and recognising that if that is significant, so that it's recognised at present value. As the current guidance does not explicitly address grant expenses, the existing standards do not provide specific guidance to cover performance obligations imposed by a grantor, nor does the guidance address the obligation made by the grantor when agreeing to pay or make a grant. As David just mentioned, IBSASB has got a current project on transfer expenses, which explicitly provides grant guidance for grant expense transactions. ED 72 addresses recognition and measurement of performance obligations, distinguishing between whether the transfer recipient is required to satisfy performance obligations by transferring goods or services to a third-party beneficiary, and where the transfer recipient is not required to satisfy performance obligations. ED 72 also provides guidance which would address the accounting for multi-year grants. A number of jurisdictions follow international standards, and this can be variably IFRS, IFRS for SMEs, or IPSAS. They adopt the provisions following the accounting treatments for the recognition of grants, as I've just discussed. Other jurisdictions are based on the same or similar provisions and provide additional guidance. One set of national guidance takes the general approach to the recognition of liabilities for grantors, but also explicitly includes the concept of performance obligations. And additional guidance is provided in some national sets of guidance that specifically covers grant expenses, performance-related conditions, and what constitutes an obligation from which an NPO cannot realistically withdraw, whether it's conditional or unconditional. So largely, international standards and national standards require an entity to recognize a liability and an expense when a grantor is committed to providing resources to a grant recipient. Some jurisdictions include provisions that explicitly refer to performance obligations, or where the grant is conditional or has conditions that need to be met. So additional guidance there. With significant commonality across these two standards, we're only proposing two alternatives. So alternative one is based on either of the frameworks, either IFRS core standards, IFRS for SMEs, or IPSAS. And any of those frameworks would be supported by additional guidance to assist non-profit organisations with their specific issues. So this guidance would cover recognition, measurement, and disclosure, including performance-related conditions. And in terms of disclosures, it would include recommended additional disclosures. And this would include recognising a liability and expense for a grant when an obligation has been created, providing additional guidance on performance-related conditions, providing additional guidance on multi-year grants, and providing guidance on disclosure of grants and related commitments. But under this option, there would be no additional disclosures mandated. And as stated, the guidance could be prepared to align with any one of the international frameworks, but in line with the proposal in part one of the consultation paper for IFRS for SMEs to be the foundational framework, that would be the preference. Alternative 2 builds on alternative 1 with additional guidance on recognition measurement, but requires that performance obligation approaches in ED 72 on transfers expenses are incorporated into the guidance where IPSAS isn't being used as the base. Incorporating these principles would provide additional guidance on grants with performance obligations and multi-year arrangements. Under this approach, NPOs similarly would recognise a liability and an expense for the grant when the obligation has been created, be provided with additional guidance on performance-related conditions and multi-year grants, and also on the disclosure of grants-related commitments. It would also include that if awarding grants, that if the grantor is awarding grants, that it will be required to disclose significant transactions such that all users can understand the transactions and the commitments that have been made by the grantor. So the key difference with alternative 2 is that there are mandatory disclosure requirements and additional guidance that follows the proposals in ED 72. To help in understanding the implications of the alternatives, the consultation paper looks at the relative advantages and disadvantages through 4 perspectives: technical, practical, stakeholder, and cost benefit. These are not exhaustive, but are intended to try and help bring the alternatives to life. So in looking at the relative advantages of alternatives relating to grant expenses, from a technical perspective, alternative 1 follows the international standards. Practically, it will provide additional guidance, which will help NPOs decide when they have an obligation to pay a grant, and also when to recognise multi-year schemes. Alternative 2 would follow IPSAS, which could assist in recognition decisions, And from a practical perspective, this additional guidance may assist in recognising multi-year schemes. Also, from a stakeholder perspective, it may increase comparability of grant reporting across NPOs. In looking at the relative disadvantages, alternative one may mean from a stakeholder perspective, there is less comparability across NPOs due to different interpretations of whichever standard is followed. And for alternative two, from a technical perspective, following IPSAS may create departures from IFRS and IFRS for SMEs for complex arrangements with multiple performance obligations, but probably not for more simple arrangements. So alternative two offers potentially greater comparability of NPO information, but with greater departures from IFRS and IFRS for SMEs for complex arrangements with performance obligations. And that's a trade-off that will need to be considered as we look at the responses that come from the consultation paper. The consultation paper asks 4 questions, and these questions go to have we got the description of the issue right, and to try and gather thoughts about the alternatives. These 4 questions are standard to all of the topics and are intended to capture feedback that will help us progress each issue as we start to develop draft guidance. So we want your views on this and any other issues that have come up, including what might add most value and any practical considerations. So time for a bit of a pause again, and a chance to get some feedback from you. And what we would like your feedback on at this point is the alternatives that I presented. Interested to know whether you prefer one of those or whether you've got another alternative that you think is appropriate, and trying to get some sense of why you prefer that alternative. Your responses are not binding on you. I think it's just helpful in giving us some idea about your thinking about this. So we'll put the poll up now, and we'll give you just a bit of time to read through the questions and let us have your responses. So we have a small number of people who've posted their views at the moment. It'd be great to hear from a few more of you in terms of your preferences. That's great. Give you another 30 seconds. Okay, great. Thank you. Paul, could you close the poll at that point? Okay, so what have you had to say? So 60% of you are in favour of alternative 2, and that's with an IPSAS type solution, central to how that might be taken forward. And we've got one suggestion of an alternative. It might be good to hear through the chat a bit more about that alternative and why you think there's another approach. Why do you have this preference? Tying in joint first place, 60% of you think that that is better conceptually and that it will provide transparent or better information. I think they are by kind of quite a long way the two biggest ones there. Also, some thoughts about comparability and aiding comparability. I think that's the conceptual basis, and the information seem to be by far and away the lead. Less focus on change from where people are now and the cost to implement, which is really interesting to see that. I think sometimes we see that the no change is the preference. So good to see how you're thinking about those issues. So I'm going to stop sharing the poll again and be keen to get your thoughts on those alternatives, on the poll responses that came through, and any issues. The alternative to the alternatives. I'm very interested to hear about that as well. So Sam, you've been keeping an eye on the chat. Are there any points that you kind of want to raise from that?
Sure. So David Hardidge was the alternative, but I'll come to him in a minute. David Russell, do you want to come in with, you had two different points, one about the model, a question about the model and a point about complexity. It'd be great to hear you come in. David Russell. David, are you there? Okay, maybe not, but maybe shortly. Francis Mba, did you want to come in with your comment? If you want to come in, you can just unmute yourself or put up your hand. Oh, David's got a technical issue. Well, let me share David's comment. So his question was first on the model, the proposed model that you set out for us. He's asking, is this hybrid approach a stepping stone before a complete IFR for NPO, or is this sort of how we're getting to it? I think it'd be great to shed some light on that.
So what we are proposing by way of this project is a set of guidance. We're not talking about a brand new set of standards for non-profit organizations. So this hybrid model is very much how we are looking to develop the guidance to support the advice that we give to non-profit organizations to help them prepare financial reports and statements. So for the purposes of this set of guidance, it really is the mechanism that we're intending to use. Hope that helps.
Yeah, great. So it's not something first and then it is the approach to developing the complete guidance, if you like.
Yeah.
And then David's other comment, he just said, I have two words that come to mind: complexity and capacity. If I can assume some flesh on that, I guess this all looks very complex. And when I think about the types of NPOs that might be applying it and their capacity, it seems too difficult. I'm putting words in David's mouth. Oh, there we go.
Sorry, I managed to get my computer working. Yeah, that was it. More just sort of thinking about the accounting systems and rolling this out. I mean, I know we're way down the line, way from that, but it seems almost like, good market for accountants to get into.
No,
I mean, I know there's problems on the other side by not doing it. I'm all for it, but
yeah. No, look, and we'll look, and this is something that frequently gets raised with us. Keep it simple. Simplicity are words that we frequently hear. I think what we're looking to do through this webinar and through the consultation paper is kind of to bring to life, if you're starting with international frameworks, the types of accounting issues that we need to deal with. And then, you know, the step beyond that is saying, well, if we've got all of these accounting issues to deal with, what is our best step forward in providing guidance for non-profit organizations? And in doing that, we have to recognize the complexity that is there, so that we can then work through how we deal with that. And so, you know, responses that we get to the consultation, you know, are, you know, that bring that to life are incredibly helpful for us to give us an evidence base about how we might move things forward. So yes, I really recognize the point that you're making.
Yeah, and we hear that a lot, and I think as Karen's mentioned with all these examples, real life is complex in terms of the way these arrangements are structured, and trying to find as simple as possible accounting solution that's implementable, and yet recognizes the complexity of the real situations that are there, I think is one of the key challenges of this project, really. Yeah. So I think you hit the nail on the head there of what keeps us awake nights.
And tries to keep things conceptually sound, because that's important to the integrity of what we're doing as well. You know, if we depart too far away, then we might not have a credible set of guidance. So there's lots of things that we need to balance and trade off as we kind of work through this.
Great, then Fernando, would you like to bring in Jose's comments that he made in Spanish? It'd be great to hear you put them forward.
Sure. Yeah, let me summarize Jose's points as well. First one is well, I think I put on the chat the type of grant. Well, let me briefly summarize Jose's experience. Jose is the chairman for the accounting standard in Venezuela, so just to give an idea to the audience who Jose is in Venezuela. So, and the first point from Jose is it has to be very clear the type of grant, the related performance obligation, which is critical to identify entity commitments, the entity. The second point is that Jose brought to the chat is that if the entity commitment is the management of the resources, which comment aside, Jose prefers to label, use the word resources instead of, you know, typical for-profit terminology. You know, I think I don't have to say this in this environment. I mean, revenue expenses is a terminology from the for-profit world, as we all know that. So Jose's point, the second point specifically, is that he would prefer to label as the resources on the non-NPO world. Mm-hmm. But the point is, identity commitment is the management of the resources received, and that his opinion, this should also be identified. The third point, to be very short, it is also important to have guidance available to recognize the inflows and outflows of resources. So it's a conceptual discussion. If I can add more to the Jose's points, which is very important, because as we all know, the conceptual technical accounting discussion, as David brought some points on to the chat, are very important. It's something that I think some accountants, we don't like to discuss that concept on the theory, but is the foundation for a standard.
Absolutely. Yeah.
In my personal opinion, if I can add more points to the Jose discussion. But the last one, to finish the Jose's comment, is that okay, it's also important to have guidance available to recognize the inflows and outflows of resources. This is a better terminology as used in the for-profit world. I mentioned already that revenue expenses, and also maybe relabel the statement of income. FYI for the audience is something that Jose may want to share, is that in South America, if you do a quick research, you will find that NPOs are labeling, you know, the the income statement as an income statement is, as we all know, in an NPO, the income statement should not be labeled as an income statement as the for-profit world are labeling that accounting statement. So that's another point to close this comments on Jose on the specific terminology. That's another.
Thank you very much, Fernando. It's terminology is going to be really important for us, and one of the things that we've found in our outreach so far is that different terms mean different things in different jurisdictions, and there is the for-profit and the non-profit demarcation, if I can call it that, but there's also jurisdiction specific terminology as well. So it's great to get feedback around that, because this needs to be relevant to people and they can understand what it's trying to achieve, and highlighting some of those issues is really quite helpful. Thank you.
So Karen, I don't know if you want to move on, or if you want another question.
I'm gonna
there's also David's other. So I just very quickly summarize the alternative that David Hardage mentioned. I don't like the proposed mirror accounting under IPSAS exposure draft 72, he says, but if IPSASB issues a realistic and implementable standard, then that would probably be the best. So there's David's alternative.
Thank you. So ED 72 Mark II, we'll watch this space to see how that develops. So I'm going to move us on to talk about NPOs that act on behalf of other entities and the alternatives for that. But before we do that, just to quickly go through the current international guidance focusing on agency arrangements that is in the accounting standards. This is probably going to be quite complex, and we're going to cover a lot of this when we have a webinar on reporting entity. But I think it was just important to acknowledge and summarize what's already there. So we have IFRS 10 on consolidated financial statements and IFRS 15 on revenue from contracts with customers. We also have section 23 of the IFRS for SME standard. We have IPSAS 9, revenue from exchange transactions, and IPSAS 23, revenue from non-exchange transactions, and IPSAS 35 on consolidated financial statements. So there's quite a bit of guidance that is relevant to this topic, but it mostly relates to the definitions of control and how to account for revenue in matters of agency and principal rather than expenses. So there's a bit of a read across happening here. Excuse me, my laptop is moving on its own, apologies. So the guidance on revenue is useful to understanding the implications for expenses, because where an NPO is acting as an intermediary on behalf of another entity, it might have both revenue and expense considerations. Generally, the guidance provided by the standards is based on the core principle that an entity is a principal if it controls the economic resource in the transactions. And current international guidance has one of two approaches in determining control. Guidance either follows a controls approach or a risks and rewards approach to indicate control. And so whilst the framework for assessing control differs, indicators of control are provided in the relevant standards to help determine whether an entity would be acting as principal in a relationship or as agent. And it focuses on the ability to control as being aligned with when it would be a principal. The indicators in the standards include consideration of which entity has primary responsibility for the provision of a good or service to a customer, things like inventory risk, credit exposure risk, and the ability to set prices for goods or services. And you can see that that's kind of very much kind of in the for-profit type of language. International standards, both within their conceptual frameworks and in specific standards, follow the principle that holding legal title to an asset is not sufficient to require its recognition in an entity's balance sheet. That not only applies to revenue, but to assets like property, plant and equipment. And so what must be established is that the entity controls or has the right to control the economic benefits and the service potential inherent in an asset. In the IFRS suite of standards, IFRS 15 on revenue is based on a control concept with revenue only recognised if it is controlled. IFRS 15 does not provide guidance on non-exchange transactions like grants. So even if you were looking at the mirror, you wouldn't see the other side of that. The session on reporting entity will talk about control in IFRS in more detail, but the IFRS standards talk about things about power that needs to exist, exposure to rights or variable returns, and the ability to use power to affect the amount of returns that the investor gets. So to have power over another entity, an entity must have existing rights that give it a current ability to direct what it calls relevant activities. And the relevant activities are those activities that most significantly affect the nature or amount of benefits from involvement. There's quite a lot of complexity in that I'm not going to unpack today. So in the context of deciding whether transactions are being conducted as principal or agent, accounts preparers would need to look at the nature of its role in the transaction and whether it meets the definition of control that's consistent with these standards. The accounting treatment in IFRS for SMEs for agency relationships is included in the section 23 on revenue. And although this standard doesn't explicitly refer to a risks and rewards approach, the decisions on the supply of goods are effectively taken using this kind of approach. And the IFRS for SMEs standard specifies that in an agency relationship, the agent must recognise in revenue only the amount of its commission and not the revenue passing through. So revenue is only recognised where a non-profit organisation is acting as principal. Within the IPSAS suite of standards, both IPSAS 9 on exchange revenue and IPSAS 23 on non-exchange revenue establish that amounts collected as an agent of government do not give rise to an increase in assets or revenue of the agent. And that's because the agent can't control the assets that it's collected for its own benefit. So the collection of taxes by a tax authority does not increase the net assets of the part of government that's collecting it, because it's doing it on behalf of the whole of government. And these principles are capable of being applied to other non-exchange transactions, such as the distribution of grants. IPSAS 9 sets out that an entity is acting as an agent when it does not have exposure to significant risks and rewards associated with the sale of goods or provision of services. And it has similar approaches when it's looking at control over an entity that exist in IFRS, but it has slightly amended descriptions of control to reflect public sector context, but the principles are similar. The IFRS for SME standard and both IPSAS 9 and IPSAS 23 are in the process of being updated at the moment. And the principles in IFRS 15 and the concept of control that it uses are specifically included within the considerations for both of these work programs. In terms of national standards, we've seen again that those that have developed their own standards can variably follow IFRS for SMEs or IPSAS. I think in some of these jurisdictions there is additional guidance to help non-profit organisations. For example, in one jurisdiction, Discretion in the distribution of monies to beneficiaries is a key factor in determining principal in agent, and in their guidance, if discretion exists or if a non-profit organization is a related entity, the non-profit organization is a principal in the transaction. If it has no discretion, then it's treated as agent. And in other national standards, there can be requirements to recognize transactions in the financial statements based on whether the entity controls the transaction, so additional guidance. But there are differences to how control is assessed. So there is a variety of ways in which national standard setters have dealt with this. If we turn to the alternatives that we've set out in the consultation paper, the proposal is to include NPO specific examples and guidance in all of the alternatives that we're setting out to try and aid transparency and disclosures. In many of these cases, we're proposing additional disclosures, but we recognise that additional disclosures can create additional reporting burdens, particularly for smaller NPOs. But practical guidance for preparers, we would hope would assist NPOs in making relevant judgments and reduce inconsistent treatments of transactions through different interpretations. So to turn to the alternatives, we have three. Alternative one is based on IFRS standards and uses the indicators of control used in IFRS 10. Non-profit organisations would determine whether they were acting as principal or agent based on whether they control the resources involved in irrelevant transactions. No transactions would be recognised in the financial statements where a non-profit organisation determines that it's acting as an agent in a relationship. Additional guidance on control, on how control is determined and how to measure the asset provided would be held would be provided, with specific examples to illustrate the kinds of arrangements that non-profit organisations have. Additional disclosures on material agency relationships with other entities would be required, including a description of the entities or individuals involved in the relationship, a reconciliation of opening and closing balances for material transactions as part of that too. Alternative two is based on IFRS for SMEs, where decisions on agent and principal are based on an exposure to risk and reward. As with alternative one, additional guidance and examples of non-profit entities would be provided, and again there would be a requirement for additional disclosures. So NPOs would determine whether they were acting as principal or agent based on whether they are exposed to significant risks or rewards in a transaction or relationship. As with IFRS, no transactions would be recorded where a non-profit organisation determines that it's acting as an agent in a relationship, and there would be additional guidance on control and how that's determined, and with specific examples to illustrate NPO arrangements. Again, disclosure of material agency relationships would be required, again, including a description of the entities or individuals involved in that relationships, and for material agency transaction, a reconciliation between opening and closing balances. The IFRS for SME standard is currently being reviewed, as I said, to consider the new IFRS standards. And a risks and reward approach that is currently within IFRS for SMEs will be reviewed as part of that. But I think it's useful to note that for many transactions, but not all, it would give a similar outcome to alternative one. And finally, alternative three is based on Ipsos, and this also currently supports a risks and rewards approach. And similar to the other alternatives, there would be additional guidance and examples with a requirement for additional disclosure. Non-profit organisations would determine whether they're acting as principal or agent based on exposure to significant risks or rewards in a transaction. And just like the others, no transaction would be recorded where a non-profit organisation determines that it's acting as an agent in the relationship. And the proposals on additional guidance and the disclosures would be identical to in alternatives 1 and 2. As I've said, the existing standards are in the process of being updated, and current proposals are for a controls basis consistent with IFRS 15. So once those have been updated, there is a chance, probably a good chance, that the Ipsos will deliver a similar outcome to alternative 1. So given the current work programs of IBSASB and the IFRS Foundation, it's entirely possible that the full IFRS standards, the IFRS for SME standard and Ipsos will all end up with the same approach to control within the lifetime of this project, but we can't be certain of that. And so in practice, it's possible that all approaches might end up harmonizing on alternative 1. But the application guidance that is in each of those international frameworks could differ, particularly in terms of the illustrative examples, which may or may not be helpful for this project. Similar to the analysis of the issue paper on grant expenses, we've looked at some of the relative advantages and disadvantages of the 3 alternatives. Given that IFRS has most recently been updated from a technical perspective, it's likely to be enduring for a period of time. From a practical perspective, alternative 2, with its simplified risk and reward approach, may be easier to implement, as factors might be simpler to grasp. And similarly, for those reasons, alternative 3 may also be easier to implement. All 3 alternatives offer benefits around transparency through the proposed additional disclosures. In terms of disadvantages, both alternative 2 and alternative 3 do not align with the control framework in alternative 1. And as I've said, they are under review. The proposals exposed in relation to alternative 3 make change there very likely. From a practical perspective, it may be difficult to provide examples that work and illustrate relationships for all forms of NPOs. And under alternative 1, it may be demanding, particularly for smaller NPOs, to collate the information necessary to make judgments about the indicators of control. The disadvantage about examples for all types of NPOs that I just mentioned might also apply to alternative 2. And I think it's important also to raise that from a cost benefit perspective, alternative 1 may also result in additional costs, and that might come from the assessments that are needed to implement that alternative. And though the cost of those assessments might outweigh the benefits of implementing that approach. So the list of consultation, so the list of questions in the consultation paper, the top 4 are consistent with the ones on grant expenses, and as I explained earlier, they're consistent across all of the issues that are set out in part 2. But we'd also like to hear on this particular issue about challenges that you might anticipate with additional disclosures, and also what additional disclosures might be most relevant. And so we're really keen to hear views about that we can factor into our thinking going forward. So now we move on to kind of our final poll of this webinar, where we'd like to again get your views about the alternatives that I've just presented there, get your feedback around which alternative you prefer, kind of recognizing that changes are potentially afoot in terms of those alternatives. And question 2 about why you have that preference. So we'll put the polls up again, and we'd very much like to get your views on those. So I'll just give you a couple of minutes to read through and put through your responses. Just give you another few seconds to put through any final responses that you might have. Okay, Paul, can I ask you to close the poll, please? So thank you for putting your responses through. I mean, this shows kind of a lead preference in terms of IFRS for SMEs as the base alternatively. Interestingly, if you combine the responses for alternative 2 and 3, I would take from that there is an expressed preference for a risks and rewards type approach rather than the control in IFRS. Maybe I've taken that interpretation too far, so it would be good to hear your thoughts on that. And then in terms of why you have that preference, again, some lead contenders here in terms of ease of use and better fit with the guidance model. And that perhaps that aligns with what I've just said about a risks and rewards type approach. And clearly we've set out IFRS for SMEs as the foundational framework. A lot of support for more transparent, better information, 53% supporting that, and 40% would be around supporting it would be less costly to implement. And again, most people, less people saying that it's not about change from what is currently done. So perhaps picking up on the risk and reward versus control elements of what came through, or how I've interpreted what has come through that poll. I'd again like to open up to questions and get your thoughts on what you've just heard and what you've just seen in the poll. Sam, are there any points that are coming through?
You can see nightfall is arriving in Uganda here.
Yeah.
Well, there's a few comments. I think I'll just open it up to anybody who'd like to share. It's quite noisy here, I'm afraid. Is there anybody who'd like to share? Martha Akintoye. There's a number of people who've commented.
Okay.
So if you'd like to comment, please do.
Yeah, so if anyone would like to put up their hand, if they would like to come in. We are capturing all of your comments if you're not feeling that you want to raise that. David, would you like to come in?
Yeah, look, I'm not sure that we have such a big problem about principal versus agent. I mean, yes, there's some things on revenue. The two things that I've come across, because I mentioned in the previous webinar, we've been applying IFRS 15 in Australia last year with the control-based approach. There's probably two. One is, and I'm coming from a government, usually government perspective. One is that the entity has given some money and it has to pass that money out in grants. So it's not quite a pass-through. They've got to make some judgments, but the issue is, well, if the person meets the criteria, then they essentially have to, and that's the question, give the grant out. So is there any discretion in what the activities that they're doing? And the other one is university collaboration agreement. So the one university is the lead administrating university. They get all the funds, and then they split it, might be 40, 40, 20, to make up 100%. The question is, are they essentially separately accountable for the money they receive, or is the primary or the main or administrating university a principal for the whole lot, and they essentially get to recognise all the revenue and bumps up their revenue in what they're reporting? So the two main Australian grant agreements, education grant agreements, or research grant agreements we looked at were quite specific. If you're the lead university, you're responsible for everybody. If they muck up, essentially, you're it. So we essentially said, well, that's principle rather than only recognize 100 rather than 40%. So they're my two practical examples.
And that goes to kind of what lies at the heart of the intention behind the arrangements, and trying to get a good grasp of that. I think you kind of clearly set out there what the intention was, that the lead is responsible, and that then helps make the subsequent decisions and support the accounting that then follows on from that. So those intentions are really important. Yeah, thank you, David. Is there anybody else who wants to put their hand up? No? Okay. So now that I've taken you through these topics, I'm hoping, and we hope, that you feel ready to respond to them in the consultation. We are really grateful to kind of get the input that you've had today, and we hope that this has been helpful to you, because it has been really helpful to us to get your inputs, comments and questions. We're hoping that the discussion has helped clarify some of the proposals and your view on them. So the important next step we'd like to encourage is for you to go ahead and submit your own formal responses, either as an individual or as an organisation. And as it says up on the screen there, I'm a reminder that the closing date for these topics is the 24th of September. But you might find it easier to respond to the questions whilst today's webinar is fresh in your mind. You can build up your feedback as we go through webinars, or as you work through the various topic materials, or you can just respond to today's topic if that's your prime area of interest. All of the information is on the IFR for NPO.org website, including information about a couple more webinars that are coming up over the next few weeks. So in terms of responding to the consultation paper, we've tried to make it as easy as possible. And there are 3 different ways you can share your views. As I said, all that information is on the website. If your organisation already has a process for submitting comments on accounting standards, then you can submit a comment letter, as you might usually do, and upload it to our website. If you'd like to submit a response as an organisation, or collaborate with others, or just simply work offline, then the second option is to download a Word template that we've created and is available on the IFR for NPO website. You can download it, work on it over time, and then upload it to the website when you're done. The third option is great if you're submitting as an individual, and that's an online survey. You need to put in some personal information, but once you've done that and have saved it, you can come back to the survey as many times as you want before you're ready to submit it. So you don't have to do it all in one go. So we really hope that you feel motivated and confident to submit a response, even if you've not done something like this before. A large number of responses from all regions of the world will really help add quality and credibility to the guidance we produce. And we say this many times, we want to hear from those that have already got guidance through national standards and those that don't. We want to hear about what works well as what doesn't work well as part of this, because that will really help us as we move forward. So just before we get to close, I kind of like to sort of focus on some positives, because we've heard a lot about issues and challenges in the webinar today, but we're interested in terms of what your hope is for the future. The guidance offers the opportunity for a way forward, an opportunity to address the issues and challenges we've talked about. So we'd like you to take part in a Menti poll to share your thoughts on this. So if you've got a device, whether that be a phone, tablet, laptop, or whatever you have available, and can open a window in that and go to www.menti.com and access that. If you go into that, it will ask you for a code. The code is on the screen, 82760921. We'd be interested to kind of hear your thoughts on that. You don't have to leave this meeting to be able to do that. And we've put up in front of you a word cloud. That word cloud includes the words that came up in the webinar that we ran earlier today. But we'd really like to get your thoughts too. So we want to capture the positive, the hopes for the future that we can build on going forward. Accountability is the strongest word in the word cloud at the moment. That's just got larger, so that's really interesting. But also a lot of support for uniformity, clarity, and consistency. I see acceptability by grantors in there. I think that's a really important point, and great to have that out as a hope. I can assure you we're working very hard on that. If anyone else has got anything else they want to add, any additional words that want to go into the word cloud. We will keep this open for a while, so please do feel free, even if we've taken it off the screen, to add your words so that we can capture those hopes, which really help us. Yeah, so accountability, uniformity, out there. It's good to see accountability up there, transparency, consistency, simplicity. Okay, so some important words there. Okay, if anyone else got any else, please do continue to share them. I'm just going to take that away and just reshare my screen just to close out our webinar today. And sorry, let's go back. So I just wanted to let you know kind of what happens next. I can go back to that. So you might be wondering what happens, where are we in the process, what happens to your responses. As shown here, we're in the outreach section of the consultation paper at the moment. And starting in Q3, we will start to analyse the responses that come in from that. The forward, and it is those responses that are going to shape the draft guidance that we then develop. Our forward timetable is going to depend very much on the quantity and nature of responses that we get, but we will absolutely be developing the draft guidance in 2022, and we look forward to kind of continuing outreach and engagement with you and other interest groups so that we can continue to get input as we go forward. And finally, so how can you stay connected and engaged whilst we're doing all of that hard work, looking at your responses? We'd encourage you to subscribe to our quarterly newsletter if you haven't done so already. That will keep you up to date and also ensure that you're aware of any relevant events that are happening in your region. We'll put a link to that in the chat. We'd also encourage you to follow us on social media, specifically LinkedIn and Twitter, if you're active there. If you can like, comment or share our posts, they get seen by even more people, and that creates the opportunity for even more voices to be heard. Non-profit organizations are incredibly diverse across the globe, and it's really hard to get to everybody because of that diversity, and you can really help with our mission to try and get to as many people as possible. You can always email the project or myself and Sam as well, has been part of the event today, and those email addresses will be made available to you. We will be sending a follow-up email with this PowerPoint presentation and the recordings, and those will also be available on the website. So we'll put all that information together so that you've got them all in one place if you're not able to pick them up from the chat. Also, just a bit of a plug, if you have got colleagues in your organizations or in your networks who you think would be interested in similar events, please encourage them to check out the page on the website to see if there are things that they might be interested in. So I'd like to thank you again for your time, efforts, insights, the useful information that you've shared with us today. We really do appreciate it and look forward to engaging you as we continue on this journey to develop the world's first internationally applicable financial reporting guidance for non-profit organizations. I don't know if Sam, you have a final word that you would like to make?
Well, it's a bit noisy here, but very briefly, just to say again, thank you so much, everybody who's come from all over the world. It's just been great to hear your ideas and the inputs in the chat. And be assured we'll be listening and analysing and trying to really grasp everything that you've shared with us. So thank you so much.
Great. So thanks
thank
again.
you, Karen, for a great course.
Thank you, and thanks again, everybody. Really appreciate you being here, and I hope to continue to engage with you as we go forward. So thank you very much. Have a great day, evening, week, wherever you are in the world, and whatever time zone you're in. And so it's goodbye for now. Thanks very much, everyone.
Thank you, Karen. Finally, to recognise Fernando. Thank you for your translation work. Yes, really appreciate that. And yeah.
Thank you, Fernando.
Thank you. Bye.